This is not financial advice. Everything in this video is for educational purposes only. Imagine you just got your paycheck. After rent, groceries, and bills, you've got $500 left over, and you've got two options in front of you. Option A, put that $500 toward your student loan. Chip away at the debt. Sleep better at night knowing the number's going down. Option B, invest it. Put it into an index fund. Let the market do its thing. Most people, and I mean the overwhelming majority, would choose option A without even blinking. Because that's what we've been told our whole lives. Pay off your debt first. Get out of the red before you go into the market. It sounds responsible. It sounds smart. It sounds like exactly what a financially disciplined person would do. But here's the thing. For a lot of people, in a lot of situations, that advice is actually costing them money. Real money. Thousands of dollars over the course of a decade. Sometimes more. And today we're going to break down exactly why. Here's why this matters to you directly. Debt is one of those topics that carries an enormous emotional weight. Nobody likes owing money. There's a psychological discomfort that comes with seeing a negative number attached to your name, whether it's a student loan, a car payment, or a credit card balance. And that discomfort is completely valid. But financial decisions made purely from emotion, they rarely produce the best outcomes. The question we should be asking isn't, does this debt make me feel bad? The question is, what is the mathematically and strategically optimal thing to do with my extra money right now? And the answer, surprisingly, is not always pay off the debt first. In fact, blindly following the debt-free before investing rule without understanding the nuance behind it could mean you miss years of compounding growth that you will never, ever get back. Time in the market is one of the most powerful forces in personal finance, and every month you delay investing to throw money at low-interest debt is a month of compounding you've permanently sacrificed. So let's build this from the ground up. Before we get into the strategy, let's make sure we're speaking the same language. When we talk about debt, not all debt is created equal. Think of it like temperature. Some debt runs hot: credit card debt, payday loans, personal loans from some lenders. These can carry interest rates of 20%, 25%, even 30% or higher. That's expensive money. Every dollar you owe is actively working against you at a brutal pace. Other debt runs cold. Federal student loans in the U.S., for example, often sit between 5% and 7%. A mortgage might be 6% or 7% in today's rate environment, but historically, mortgages have been as low as 3%. A car loan might be somewhere in between. Why does the temperature of your debt matter? Because we need to compare it against something else. That something else is your expected investment return. The S&P 500, the index that tracks the 500 largest U.S. companies, has returned an average of approximately 10% per year over the last century. After adjusting for inflation, that number drops to around 7%. But let's use the nominal figure, roughly 10% annualized over the long run. Now here's where it gets interesting. If your debt carries an interest rate of 6% and your investments are historically returning 10%, you are, mathematically speaking, ahead by investing. The return on your investment is outpacing the cost of your debt. This is what's called the opportunity cost of paying off debt early. Every dollar you send to a 6% loan instead of investing it is a dollar that could have been working at 10%. Think of it like this. Imagine you have a machine in your garage. Every dollar you put in, it spits out $1.10 at the end of the year. That's your investment. Now imagine you also have a hole in your wallet. Every dollar in there slowly shrinks at 6 cents per year. That's your low-interest debt. The question is, do you patch the hole first, or do you start feeding the machine? If the machine produces more than the hole costs, you feed the machine. Here's the core insight, and this is the part most personal finance advice glosses over. The decision of whether to pay off debt or invest first should be driven by one thing: the interest rate on your debt relative to your expected investment return. Let's call this the crossover point. If your debt's interest rate is above your expected investment return, pay off the debt first. It's the higher return move. If your debt's interest rate is below your expected investment return, invest first, or at least simultaneously. And for millions of people carrying federal student loans, low-rate car payments, or old mortgages locked in at 3 or 4%, they are almost certainly below that crossover point, which means every extra dollar they throw at that debt instead of investing is a net negative decision in the long run. Let me give you the numbers in real terms. Meet Alex and Jordan. Both are 25 years old. Both have $500 per month of extra money. Both carry $20,000 in student loan debt at 5% interest. Alex follows the conventional wisdom. She puts that entire $500 every month toward her student loan. It takes her about 3.5 years to pay it off completely. Then, at age 28.5, she starts investing $500 per month into an index fund. Jordan takes a different approach. He makes the minimum payment on his student loan, let's say $200 per month, and invests the remaining $300 every single month starting at age 25. Fast forward to age 65. 40 years of investing for Alex, starting at 28.5, versus 40 years for Jordan, starting at 25, but with a lower monthly amount in the early years. Assuming a 9% average annual return, a conservative estimate for a diversified index fund portfolio, Jordan ends up with approximately $1.4 million. Alex ends up with approximately $1.15 million. Jordan is ahead by roughly $250,000, despite paying more in total interest on his student loan. That's the compounding gap. Those 3.5 extra years at the beginning are worth $250,000 by the end. Time in the market wins, even imperfect time. This isn't just theoretical. A 2016 study by financial researchers at NerdWallet ran a similar simulation comparing early debt payoff versus split investing and paying strategies. Their findings consistently showed that for debts below approximately 6 to 7% interest, a hybrid approach, investing while making minimum or moderate debt payments, produced better long-term outcomes than aggressive early payoff. Fidelity's research on retirement savings echoes this. Investors who started contributing to retirement accounts in their mid-20s, even in small amounts, consistently outperformed those who waited until their early 30s to start, even when the later starters contributed larger amounts to make up the gap. The math behind this is compounding, and the most important variable in compounding isn't the amount you invest, it's the time. As a rough illustration, $1,000 invested at age 25 at 9% annual return becomes approximately $31,000 by age 65. That same $1,000 invested at age 35 only becomes about $13,000. Same money, same return rate. A decade of delay costs you more than half your outcome. Warren Buffett has said that the vast majority of his wealth was accumulated after his 50th birthday, not because he suddenly got smarter or started making bigger bets, but because of the sheer mathematical weight of compounding over time. He started investing at 11. That head start is almost incomprehensibly valuable in hindsight. Now that might sound like I'm telling you to never pay off your debt aggressively. I'm not. This is where nuance matters, and I'd be doing you a disservice if I gave you a black and white rule. There are absolutely situations where paying off debt first is the right move. High interest debt is the obvious one. If you're carrying credit card debt at 22% interest, no index fund in history has reliably returned 22% annually. Pay that off, aggressively. Before you invest a single dollar beyond your employer's 401k match, which we'll get to in a moment. Psychological peace has real value. This is something the math can't fully capture. If carrying debt causes you significant stress, anxiety, or decision-making paralysis, the mental clarity of being debt-free might allow you to make better financial decisions overall. Personal finance is personal. If paying off debt aggressively makes you feel secure enough to stay the course during a market downturn, that behavioral benefit might outweigh the mathematical advantage of investing earlier. The employer match is non-negotiable. If your employer offers a 401k match, say they'll match 50% of your contributions up to 6% of your salary, that is an instant 50% return on your money. No debt has an interest rate that competes with that. Always contribute enough to capture the full employer match before doing anything else. And one more, emergency fund first. Before you pay extra on debt or invest, make sure you have 3 to 6 months of essential expenses in cash. Because if a financial emergency hits and you have no liquidity, you may end up taking on more high-interest debt to survive it, which undoes everything. So the order of operations looks something like this. Emergency fund, capture full employer match. Pay off high-interest debt above approximately 7%. Then, for remaining funds, split between investing and moderate debt payoff based on your interest rate. So what do you actually do with this? Step 1. Know the interest rate on every debt you carry. Not approximately, exactly. Log into every account and write it down. This is your starting point. You cannot make an intelligent decision without this number. Step 2. Compare it to the crossover point. Is your debt above 7%? Below 7%? That rough threshold is where the math starts to shift. Above it, prioritize payoff. Below it, investing alongside minimum payments likely wins over time. Step 3. Don't ignore the emotional variable. If carrying debt genuinely destabilizes your financial behavior, causes you to panic, avoid looking at your accounts, or make impulsive decisions, factor that in. The best financial strategy is the one you will actually stick to. Step 4. Never miss the employer match. This bears repeating. If there is a match on the table at your workplace, that comes before everything except your emergency fund. Step 5. Start investing as early as possible, even in small amounts. A $50 monthly contribution to an index fund started at 24 will outperform a $500 monthly contribution started at 34 over a long enough time horizon. The amount matters less than the start date. The conventional wisdom, pay off all debt before you invest, is well-intentioned. It protects people from complexity. But for people carrying manageable, low-interest debt, following that rule rigidly could mean walking away from one of the most powerful wealth-building tools available to you: time in the market. Does it really matter if your debt balance is zero, if your investment account is also zero at 35? Not really. What matters is that you're building both, strategically, with a clear understanding of which lever gives you the best return on each dollar. That's the breakdown. The crossover point, the compounding gap, the order of operations, and why the payoff debt first rule deserves a lot more nuance than most people give it. If this changed how you think about your own finances, or if you know someone who's been putting off investing because of debt, this might be worth sharing with them. If you enjoyed the video, please like and subscribe. It genuinely helps this channel reach more people who are trying to figure this stuff out. And if you want to go deeper, the next video on index funds for beginners is right here. I'll see you there.